Good morning and welcome back to Almus Market Mornings, your daily dose of global financial updates. The trend in the past 3-4 months has been of a recovery in the European region. PMIs have been improving gradually, as shown by data from the EU and the UK. PMIs are Purchasing Managers Index and it indicates the direction of economic trend in the manufacturing and the services space. It's often claimed to be a leading indicator of growth. Morning, JK, it seems even with the higher interest rates, economic activity is stabilizing. Do you see any prospect of delay in rate cut in the European region following what's happening in the US?
Good morning. Good morning, Swaraj. Yes, yesterday was the day on which we saw diverse trends in the PMI between US and other regions. So we had the UK, Euro, and even Australian and Japanese PMIs beat forecasts, while that in US actually came lower, and that was actually a big variation from what we have been seeing for quite some time now. In US, both the manufacturing and services sectors showed a sharp decline, while we saw the overall business activity in the Eurozone expanded at fastest pace in nearly a year. And buoyancy in the recovery of bloc's dominant service industry more than offset a deeper downturn in the manufacturing. In fact, Germany showed a very strong momentum as well. The picture was not too different in UK economy. Private sector activity expanded for sixth consecutive month in April. Services rose strongly to 54.9 from 53.1 in April, surpassing expectation of 53. Now, to answer your question whether it changes the interest rate expectations, can't say right now. There's a lot of time between now and June, the earliest time when Europe and UK are expected to cut rates. But we may have some doubts creeping in if the steady stream of strong data from Europe and UK continue. And in fact, yesterday in UK, one of the MPC members, Mr. Pill, actually said that the picture is not too different from what it was earlier as far as the interest rates are concerned. And this is contrasting with the earlier statements from Mr. Bailey and also Mr. Ramsden. And again, that was clearly reflected in the UK yields and the UK pound, which went up yesterday. So, based on these movements, in fact, yields were moving up in Europe, but the moment you had the weak number from US, yields dipped strongly, and in fact, that led to a good response to 2-year big bond sale by the Treasury also. But the yields have bounced back a little bit after that. After, in fact, the high seen in 2 year was 5% once again, then fell back to 4.93, and now it sits in the middle of the range. Not really crashing based on the US data, because we have more issuances coming from Treasury in this week alone. There were no Fed speak due to the blackout period ahead of the Fed meeting on May 1st. Not much change in market expectation on Fed rate moves after yesterday's data as well. And it still shows first cut in September and total of 2 cuts this year. The stocks, of course, had a good day, softer yields, good earnings report from some mega companies, including General Motors, as well as some tech companies helping Nasdaq in particular gaining more than 1.5%. More positive results after the bell have helped the futures rise further, and the Asian markets are rallying strongly too. The global composite stock index yesterday rose 1.22%. Now, interestingly, it is the turn of UK stock market to hit a new all-time high yesterday, surpassing the high seen last in February 23. You would have noticed that UK market has been quite underperforming for the last 2 years. Ever since, in fact, Brexit, that has not performed as much as the other markets. Now, has the baton of global market stunning rally of last few years been passed on to UK is something that we will wait and see. On the currency, dollar index steadily weakened during the day, initially pushing down after Eurozone PMI surveys beat expectations, and later slumped again after the US data showed economy slowing. Now, Euro strong recovery has been the main driver of dollar weakness, while GBP also recovered, with PMI pointing to further expansion. As I said, the chief economist of Bank of England making a hawkish comment also helped the pound recover. Just a few days back, after a break of 1.24, people were looking at 1.20 on the pound based on interest rate expectations being brought forward. Now, while data from US is read negatively, and that in Europe and GBP was positive, picture on rate cut definitely has not changed as far as current situation is concerned. Now, yen continues to hover near 155. Market wanting to test the BOJ resolve on defending the currency at that level. Any action from BOJ is probably will come after Friday or on Friday itself, or when they announce their latest policy decision. Uh, Whether they will tweak some portion of their dovish policy and help the yen recovery is something that we'll wait and see. Chinese one weekend in Asian hours after central bank fixing was higher than expected, although offshore yuan regained after the US data came soft. Yuan move is linked as much to US yields as to the fortunes of yen. And if we do see strong intervention from BOJ, it can lead to yuan posting gains as well. Gold profit taking and easing of tensions in Middle East led to gold falling more than 5% from its all-time peak. 2431 high traded and 2290 was seen yesterday. And with US data coming soft, bargain enters in gold, we're seeing lapping up the yellow metal, pushing it back to 2330. However, unless we see a continued slump in dollar or rate cut expectations changing or yields falling sharply, gold is unlikely to gain much. We expect more correction towards 2260 at least. On the rupee, yes, it was on the stronger side, but nationalist banks were good buyers at 83.30, giving a sense that we are somewhere closer to where the central bank wants the bottom to be in the USD INR, which I feel is at 83.20. Even if we do get some more, soft data from US and interest rate or rather yields falling, 83.15 to 20 seems to be a very strong zone. Unless you see, bigger reversal in yuan or yen, this is likely to hold, and the upper end of the range will be around 83.50. We have a lot of data coming up, today for Germany, another indicator on how the Europe is recovering, and then PCE and GDP data from US later in the week. Thank you.
Thank you, JK. And just to quickly summarizing, the narrative which we are gathering is the divergence in PMIs. PMIs from UK, EU, Japan, and Australia, they all beat forecast, while in the US it showed a decline and it came lower than a forecast. And some recovery was seen in the sterling and euro post this data. And if the growth recovery picture in the UK and EU continue to remain strong, even the June rate cut expectation may be in question. As of now, it's too early, as JK said. But again, this is a narrative that can develop possibly. Japanese yen continues to hold close to 155, and if the and markets are keenly watching if Japanese tweak some policy to support the yen, and that will be quite crucial even for the Chinese yuan, which is a slightly weaker after the weak fixing by the central bank. Gold fell 5% from its peak as geopolitical turmoil subsided, and for rupee, the central banks was supporting the USD INR pair around 83.30. But as JK mentioned, 15 to 20, these are strong. 83.15 to 83.20 are strong levels which can be supported. That's it from us today. Thanks for listening. Tune in tomorrow for the latest in the financial markets.